Oh, really? Koala hugger. I will show you evidence that they don't give a shit about Reg Show Rule 144. Hold on. Let me pull it up for you. Let's go to page. All right. I want to make sure this is big enough for everyone to see. Let's begin. This is SEC filing. File number S71615. Comprehensive macro view of current flawed structure of ETFs, the XRT. The XRT is one of several major ETFs, along with their underlying equity securities, that have had ongoing excessive short selling, a high number of shares owned by reporting institutions, up to 7 owners per share at times, considering just institutional 13F reporting owners. Inadequate share creation to support legitimate settlements, significantly underborrowed shares for short sale transcriptions, improper reporting of short interest, and NSCC fails for several years. Moreover, locates affirmations, determinations in order to sell short are and have been provided daily for millions of shares sold short when data shows no sophisticated clearing firm could have reasonable grounds to believe shares could be located, borrowed, delivered for legal settlement of large amounts of short sales. XRT long-term trading metrics to contemplate. Imbalances in XRT ownership versus shares issued has continued to be found from 2011 through September 30th, 2015. The most recent 13F filings, 1,237 trading days or 4 years. Despite continuous daily shorting, selling average despite continuous daily short selling, averaging 70% of trade volume or nearly 3 of every 4 shares sold on the reporting markets, there has been no sustained increase in shares outstanding. Reported short interest nor NSCC fails. This is in complete contradiction to the expected natural results that should be found in a properly functioning supply and demand marketplace. As an example, on March 31st, 2014, just reporting institutions owned more than 5 shares for every share of XRT outstanding. However, NSCC delivery fails were just 7,728 shares. Obviously, shares were not delivered for 5 ownership claims, 42 million shares. Yet, these unfulfilled security contracts are not reflected in the NSCC data. This is a financial system red flag. The National Clearance and Settlement System is not capturing and disclosing these contractual settlement deficiencies. This is perhaps the most serious problem facing U.S. markets today. This was in 2016, I believe this was written. I.e. the improper functioning of the National Clearance and Settlement System. The DTCC NSCC is a finely tuned, time-tested, automated clearance and settlement system that is fully capable of providing the services mandated by Congress, the accurate clearance and settlement of securities transactions. However, it can only process the information that it is given. The XRT, along with the most important U.S. securities, show characteristics of significant misreporting of securities positions in the NSCC. The XRT makes this issue simple. Multiple investors claim ownership of the same shares, while the NSCC reports virtually perfect settlement occurring on a continuous basis. As we can see here in Table 4, shares claimed to be owned by institutions, 42 million, shares outstanding, 8 million. NSCC fails, 7,000. Shares owned by institutions above shares outstanding, 34 million. Reported short interest, 24 million. Shares outstanding, 8 million. Shares outstanding plus short interest, 33 million. Ownership claims by 13F filers above shares outstanding plus short interest, 9.7 million. The XRT data raises significant questions and red flags regarding what is being sold in the marketplace as XRT shares. This is a prime example of fund management team that appears to be improperly evaluating its ability to redeem assets and its liquidity. How has the XRT's management team been able to concurrently and historically account for valuation and liquidity requirements under the 1940 Act, justified compliance with the Act, and reported this accounting to the SEC when many shares exist beyond what the fund issued? Here, there are 9.8 million shares claimed to be owned above shares outstanding plus reported short interest. These securities positions were not owned by the sellers, so they were short sales, but they did not get reported as short interest. This clearly exposes another fundamental reporting flaw in the US markets. Short interest is widely followed as a metric investors can use to make critical investment decisions. When these numbers are false, all market participants are misled, even those who do not use this metric in their decisions, because so many investors do use short interest as a key component of their strategies. Short interest should be a metric considered by funds in their accounting if the numbers are accurate. Then the fund is incapable of calculating its actual exposure to liabilities outstanding from short positions. Examining these metrics, i.e. 70% short selling, no real net creation of shares, and no fails at the NSCC, clearly suggests that authorized participants, Citadel is one of them, of the XRT are internalizing and X-clearing much of the trading that is occurring for the XRT. This should raise significant red flag for the fund management that, along with the institutional ownership far exceeding the number of shares outstanding, there may be a large number of additional short shares not owned by the sellers, internalizing at clearing firms that could be required to be redeemed and potentially weigh heavily on the stability of the fund. Simply put, there are 5 owners for each XRT share. The additional redemption of those shares can render the existing shares of the XRT essentially valueless, with no liquidity left in the shares issued to accommodate the additional ownership claims. These excess owners represent undisclosed delivery liabilities at clearing firms and too big to fail institutions, which likely require settlement liquidity that is not readily available in a crisis market. I want to outline that part one more time. Require settlement liquidity that is not readily available. XRT is a clear example of settlement risk that exists today and is undisclosed by the XRT operator. XRT metrics in March of 2011, all of the outstanding shares of the XRT, which were more than 100% institutionally owned, verifiable through SEC's Edgar system, were turned over every day for 20 days in a row. There were 10 days where XRT shares issued were turned over from 2 to 7 times. On 10 days, short sales exceeded shares outstanding. On March 9th, short sales exceeded shares outstanding by 4 times. There were 65 to 73 million shares reported to FINRA as established short positions when there were only on average less than 8 million real shares outstanding. On average, there were over 8 owners of shares sold short for each real share issued. NSCC fails started the period at 32,000 and ended the period at 149,000, virtually net flat despite at least 8 owners per share. Considering the ownership scenario of the XRT has continued in the overbought position since 2011, no clearing firm should have reasonable grounds to believe that the large number of short sales will or could be properly delivered to complete settlement. Simply put, no locate provided by the clearing firm, no short sale can be legally executed by brokers or investors. Locates provide an assurance by clearing firms that shares will be borrowed and delivered to complete legal short sale settlement. The amount of short sales should be limited by the amount of shares available to lend, creating a natural supply and demand market demand market forces that constrain short selling. However, short selling in the XRT is and has been unlimited. If clearing firm does not have a legitimate belief that it will comply with the intent of federal security regulations for locating and borrowing securities for delivery prior to the execution of a short sale, violations of security laws, rules, and regulations occur. These legal short sale restrictions and potential penalties do not appear to have constrained the trading or changed the behavior of some clearing firms. This type of clearing firm is willing to provide itself or its clients with the ability to sell short with the knowledge that the shares will not or cannot be delivered to consummate contractual settlement of the securities. Table 5 illustrates these metrics, which logically indicate that reasonable grounds to believe that millions of shares each day could be located for legitimate short selling was a virtually impossible threshold to meet. Again, short positions are multiple times higher than shares outstanding without corresponding NSCC settlement failures reported to regulators. Without the national clearance and settlement system alerting the SEC to these undisclosed settlement problems, a serious concern is raised regarding the functioning of Reg Show and other regulations in effect for margin limits and excessive leverage. There is a gap in volume between the consolidated tape versus the volume produced daily by reporting exchange markets, SROs, which is attributable to non-reporting markets, including alternative trading systems and dark pools. How is this fund to rate the quality of its market liquidity that is executed on dark markets? Is it real liquidity that will be available in stressed market periods? XRT share accounting and trade total, you guys can take a look at that if you want to, but I'm just going to continue with the last bit of this. On March 9th, 2011, there were 2.5 million XRT shares outstanding and 11.6 million shares sold short on just the reporting markets. Note, on March 9th, the reporting markets show over 8 of 10 shares traded were short sales, leaving less than 2 shares sold long and available to cover the day's short sales. At the same time, there were more shares sold long than existed. The fails that were reported to the NSCC were greater than all of the shares outstanding. In effect, the XRT was asset bankrupt, and trading consisted of a supply of shares that did not actually exist. Trade volume exceeded shares outstanding by over 7 times. Short shares traded on just the reporting markets surpassed shares outstanding by 4.7 times. Of the 11.6 million shares sold short, where did the required locates come from? Moreover, where did the necessary locates come from when 10 million shares were sold short the next day and 9 million shares the following day? While years of XRT trading suggest that there were no reasonable grounds to believe that millions of shares could be delivered for settlement of short sales, 11 trading days later, on March 24th, the same trading characteristics occurred. The SEC desires the funds to take into consideration marketplace trade volume, liquidity in their evaluations, and what if trading volumes do not consist of legitimate supply and demand liquidity. Table 6 shows the value of trading the underlying assets in the XRT during March 2011. The values traded for the XRT puts the magnitude of trading into perspective. Short sales were valued at $8.5 billion in these 20 trading days on assets with an average value of $388 million. One more time, $8.5 billion on assets with an average value of $388 million. Along with virtually every other month of trading data examined for the XRT, March 2011 shows a continual buildup of large short positions versus the value of underlying assets. The XRT shows that for long periods of time, regardless of the billions of dollars traded, the underlying shares issued for the XRT by State Street were not created in sufficient quantities to support the trading activity, short selling, and ownership claims. As can be seen here in Table 6, XRT values of trading and underlying assets in March 2011. The data for the March 9th in the Table 6 shows there were 571 million shares sold short, while XRT only had 120 million in underlying assets. Where could the required locates come from for these short sales? On the next day, where did the necessary locates come from for the $484 million worth of short sales and another $441 million worth of short sales the following day? Locates from clearing firms are the first component in the chain of events that creates a legal short sale. What reasonable grounds to believe that shares could be borrowed and delivered for settlement would have existed in order to provide or accept locates for these multiple millions of shares to be sold short legally day after day? This trading share accounting raises significant red flags of operational and systemic risk across firms involved with the XRT, which could accumulate into massive stress on the valuation and liquidity of XRT. We believe these metrics should be monitored by the fund to assess the quality of its ETF. The risk presented by only viewing a portion of the data may understate the potential problems because of the hidden stresses that are being created in the secondary market. Collectively, during these 20 trading days, 11.6 billion worth of XRT was sold on just the reporting markets, so the average daily value of shares outstanding was only 388 million. Over 30 times the daily average value of the XRT was traded during just these 20 trading days. The extraordinary turnover ratio occurred despite the fact that over 8 shares had already been purchased short for every 1 share outstanding. During the 20-day period, 302 million shares were traded, turning over 8 million average shares outstanding, 38 times when all of the existing shares were and remained owned by institutions reporting SEC 13F filings. By any measure, there is an extreme amount of leverage continuing to grow in XRT, which is just one ETF product. GameStop is in 106. Since all of these shares outstanding were already owned, much of what was trading in the marketplace appears to be washed, matched type trading. The SEC wants the funds to include trade volume liquidity in their calculations, but what if there is an excessive amount of false liquidity in the marketplace? This could seriously undermine a fund's liquidity evaluation of the ETF itself. I think that's it. That should be enough, right? Oh, here you go. There is a consistent pattern of excessive short selling without share creation to accommodate the settlement of XRT securities. ETF operators know these facts. They do not have to reach for any hard to obtain outside information to understand these circumstances, as it is a simple calculation of trade volume, short interest, and 13F filings compared to their shares issued. These factors should already be considered by any fund operator under its obligations required by the 1940 Act. How's that, Koala? So when you ask me, how are they going to get shares if I've locked them up? That's how. So TLDR, ETFs make as many fucking shares as they want. They don't care about your locate.